if you see that.
Hey, hey, everybody. Hey, YouTube. My name's Max Convexity. Welcome to the channel. I just noticed David is in the house also. We got all three of us here. All right. I'm really excited about today. I'm here with David and Zed. And these guys are with Quantify. Zed, are you actually with Quantify or are you with somebody else?
Yeah, no, I got co-founder of my own firm, Convexitas, but we've been looking to join David for a couple quarters now, and it's wonderful to be officially live and working together.
Well, tell us, since we're talking already, Zed, tell us a little bit about your background at Convexitas, and give us a little bit about yourself.
Yeah, no, we'll do the fire drill versions. We don't get everybody to get bored here. But over the last 20 odd years, I've been in financial services, mostly on the buy side. And essentially what that means is I'm the one that has been investing other people's money rather than facilitating those transactions. And the career arc started a long, short distressed hedge fund, which was spectacular because I was there during the great financial crisis. So there was a lot of distress to really learn how to revamp companies, all pieces of the cap structure, whether they're trading loans or bonds or, synthetic things or equities or options. Got to do the whole menu during a pretty chaotic time. Took that knowledge base and I went to a large UK asset manager called Legal & General and helped them build out their institutional derivative overlay business. And after being there for a while, it was great home, but I said to myself, I really want to go where the puck is moving. And I thought the puck was moving towards wealth, towards retail, outside of the institutional world. And part of that is really simple. I mean, institutional world for the most part was dominated by defined benefit pension plans. And guess what? About 50 years ago, the US let corporations not actually offer those rather than previously. So those assets have been in decline for decades and really kind of hit a cliff about 5 years ago. So I said, that's not where the money is in the future. Like it's going to be in actual people's hands in retail in the wealth channel. So I shifted over to that universe. And my business partner, Devin Anderson, and I founded Convexitas about 5 years ago, where we've been delivering hedge fund quality derivative strategies directly to retail in the wealth channel.
I appreciate that. No, I'm glad you're joining us today. I've seen some of your content on the internet before, and I've actually told David that I'm looking forward to speaking with you. But David, let's talk about your background really quick. I think most of my viewers probably know who you are, but we've never really been on for a full interview. You were here for my office party about a month ago, and I appreciated that. But give us a little bit about your background and how you got into the ETF or the option business.
Yeah, you're making me feel like the third wheel here a little bit.
I'm sorry.
No, I'm
we all know you're the most famous guy.
No, not at all. Honestly, Zed is the true pro and expert here. So I'll give a brief introduction of myself. My name is David Dziekanski. I'm the founder of Quantify Funds. We are an ETF issuer focused on creating institutional quality offerings in the ETF wrapper, traditionally with leverage in a structured way that they are buy and hold leverage ETFs that take advantage of the tax efficiencies and all the benefits that come with an ETF wrapper and create true institutional quality offerings that we expect and hope will have interest in both from individual investors and also from the RIA space. As many of you guys have heard me say before, I think the financial creator space is this amazing category doing real due diligence. And I'm very excited to have you grill Zed in the options space here. And we could talk about the ins and outs of what we're doing in the fund. But I kid in that. But in truth, like the level of research that RAs actually do on products is actually kind of scary because it's, kind of like an elevator pitch or not. I spent 11 years at Title prior to this, helping create and manage and was for a portion of the time head of new product development on a lot of ETFs for Title. And the going line was like complexity kills, because if you can't sell it in 15 seconds, then nobody wants to hear it. But we're really trying to circumvent that and offer true hedge fund-like strategies that are still simple enough to understand, but take real active and skilled management on the overlay to get it done right. So I would say BTG doesn't fully fit into that category because it's a little bit of like a true institutional trading vehicle access product that is a buy and hold leverage. But this is the next step, the next evolution for our business into true package solutions. Zedo, I think you'll see further in the conversation, there's no magic in options, right? Like okay, what are you expecting to add by adding options? A lot of people have been asking me, like, how do I think about BTGD versus ISBG? And I think actually people have been shocked to say that, like, there's a reason to think that BTGD could actually underperform ISBG, right? The income one. Why? Because, like, look, both legs are taking advantage of the diversification. Both offerings have a 1-to-1 beta on both sides, but there is an actual volatility premium to be harvested on each leg of these that, like, isn't going to add 30% returns on top of the underlying asset classes, but it can add a couple percentage points in total return between the two. To go a little bit further back, traditionally a math, finance, and econ triple major, master's in quantitative finance, and I managed about $1.8 billion of ETF assets for 6,000 financial advisors. So I saw the belly of the beast from the financial advisory side. And then I was an entrepreneur, fourth employee at Title, and helped them grow that business, and truthfully thought things could be done in an even better way that even, really takes advantage of this ETF wrapper. It sounds corny, but releasing hedge fund quality strategies in ETF wrapper, like, what is the point of a hedge fund if, once it hedges, you can't redeploy it? If you look at how well BTGD did last year, we were like a $48 ETF at one point. Like, you know what? You probably should have sold a little bit of BTGD and reallocated to the rest of your portfolio because it was up 180% in like 12 months. It doesn't mean you should sell it all, but, like, these are the things that actually adds real wealth that, I think Zed will get into as well. The only free lunch is diversification. So what we've done with BTGD and this new income stacked offering is embed and force this diversification so that you can have leverage without always having to do the hard trades yourself. We embed those on emotional trades between the legs in the ETF. And, if we're looking at the flagship Bitcoin and gold, whether now in ISBG or BTGD, both will have 200% total exposure. But if you look at the actual live track record of BTGD, we've had less than 1-to-1 downside on IBIT and more than 1-to-1 upside on IBIT. And so even though we're 200% total vehicle, these stacks actually work in dampening the volatility when there's strong correlation benefits and enhancing the upside. So that's a really, really long-winded explanation into how we got here today. And, in the options world, we have up to 2 rebalancing periods a day in this fund. Zed has SMAs that he's called me on a Friday and been like, we had 14 rebalancing periods. Like, this stuff is, I think is underestimated how difficult it is to really do this in the right way. And, we at Quantified Funds, things that we have the capability fully in-house to build, we will build. But, like, this is so far beyond our area of skilled talent. We can get to the 85th percentile, 90th percentile. But if you really want to get to that cream of the crop and really offer something that, 5 to 10 years out, you are really proud of, as, yes, leverage ETFs, but leverage ETFs that you can buy and hold. And first and foremost, create a suite of products that investors have a good experience as shareholders. And I think a lot of the income space started off as, vehicles that people thought were portfolios, but turned out to be trading tools, right? And you have to actively trade them, rebalance it. And so we intend to create full solution products that you can just be the allocator to. You might not need to use as much margin on your own accounts. We will get our margin from the institutional in an institutional fashion, institutional rates, using the options world, and do it in a tax efficient way and take advantage of that heartbeat trade. So I'll shut up now because I am the third wheel here. So I'll let you and options, you and Zed go head to head on the options side.
You have a degree in quantitative finance also.
Yes.
I'll just give you.
Yeah.
You're definitely a finance bro. Let's just put it that way. But
don't call me a finance bro. Anything but finance bro.
No, and I have all kinds of questions about the option. I just opened the trades, and I'd like to look at those a little bit. But I'm more interested in just some general questions. I have maybe 1 or 2 general questions for you, David, and then I'm going to ask about the options. So what do you think about just the ETF, the business in general? You worked at Title. Now you have your own shop. Do you think the cover call or the high yield business, let's just say, is in a bubble? I mean, will it always be this good? I mean, will these things be around for it? You know what I'm saying? Now, you probably get asked this question before. Well, what's your, here's my thing. I think if interest rates go back down really low, it'll kill the business. But I don't know. And everyone disagrees with me and says I'm wrong. So I'm probably wrong, but anyway, I'd like to hear your opinion.
So I would disagree with you. I also say not that I always take the information of the ivory towers, but I saw some crazy Goldman Sachs report expecting this industry to get to like $650 billion. If you look at the structured product business, it's massive. This stuff isn't coming out of thin air. It's just no longer being sold to you through a bank. And if you look at how big structured products were in Japan, especially with an aging demographic that we're also experiencing here in the US, like I think it makes a lot of sense that structured products should be in ETFs. Well, they're a lot cheaper in ETFs. We get to take advantage of this amazing heartbeat trade that's available to us, not in every ETF in the world, but in the US economy. And if they do hedge, you as the allocator could say, wow, this outperformed. I could just buy my S&P 500 and trim something that crushed it a little bit. Like, what is the point of an alternative vehicle to your just broad-based equities if you don't have the ability to actually rebalance it when you want to and don't have to like put in notice into a hedge fund and hopefully get back, quarterly redemptions over 4 to 6 quarters. We see how quick these opportunities come and disappear, like March 2020, right? These things don't stick around for a long time. So you have to make that decision quick. So I think that we're in the infancy stages of the derivative income space, but I'll caveat that with saying these things evolve and these things change really quickly. So what it looks like today, I think, is nothing what it'll look like in 3 to 4 years. I think there are some really high quality managers doing some very interesting things in this space, but I do also think there's a lot of unfortunately, what I like to call retail candy out there that is shiny and tastes good, and then you wake up the next day and you just don't feel so good, right? You just ate a little bit too much candy. And, I think it's been difficult for individual investors to comprehend that a 100% distribution rate doesn't mean you're expected to get 100% returns a year. And I think just playing on that psyche right there, I think has grown a very awkward and weird portion of the space to really high levels. But that doesn't mean the category is going to go. That just means that I hope that some of those products get a little bit less fanfare and some more of the quality institutional grade products really come into focus more. And so that's why, we are on a title trust. Title has, options capabilities, but we were it was very important for us to partner with a caliber team like Jevin and Zed here to run this in a truly institutional fashion. Yeah. And I think as you get to know Zed, you'll get to see our trades over time. And it's not even our trades that go through. It's the limit orders that might get executed that Zed's putting up there that are teaser trades that might go through or might not. It's the way the portfolio is actually run in a true institutional fashion that differentiates, I think, what we're doing. I'm not saying there aren't other quality firms out there, but I do think some of the quality firms are doing it in a little bit more of an indexed fashion, which isn't wrong. Yeah. And that works very well for the advisors because that fits in a 30-second elevator pitch much better, But for example, now that our website went live at 5:00 today, and I'll take Zed's luster a little bit on the first leg of this options call and then pass it on to him. Yeah. But our long beta option could be 3 months to 18 months in tenure. That's a really big range. Our short option could be 1 day to 180 days, right? But other issuers are telling you, and we'll get into that. And I'll let Zed comment on that further. But other issuers are telling you, if you're going to do it index, cool. Do it index once a month, once a quarter, this, that. There's some issuers that are coming out and saying zero GTE is the panacea. You should only do zero GTE. And what I would implore you to ask Zed about when and why does zero GTE do well? When does it do poorly? What have we seen in the last year? These are trading tools. On occasion, maybe a portion of your exposure should be from very shorter dated options when you're selling premiums. Sometimes it should be longer. But to say that one approach is a panacea, I think is just doing disservice and trying to sell retail the next retail candy, right? This is the new thing. And my yield looks a little bit bigger and I still get, so if anything, I think what I'd like you guys to take out of this is that these are portfolio tools that are used to create a dish, right? And then who is your chef at deciding how much to use of what, because, using too much of one ingredient might look really good for 6 months, and then all of a sudden it might totally unwind, and all those gains just disappear. So that's my thought. Is the landscape is it's growing. It will grow at a rapid pace, but it'll look totally different in 2 or 3 years than it has today or a year ago. I mean, if you look at like what you guys were talking about a year ago versus what you're talking about today, think about how much that has evolved. And I don't think that pace of evolution is going to slow down.
Well, that ties in with what I wanted to talk with Zed about, or what ties in with the option part of it. So I think that I think that, when these funds first came out, that there was, some issuers went for the low hanging fruit, and there was funds with big yields and they got lots of press and stuff. But now they've become more sophisticated. It's the business is getting 3 years old, and there's funds coming out now 3 years later, really different than they were 3 years ago. So no, it's fun to be around. But my issue was, I think the funds that came out the first year, the problem with them was that they were just old-fashioned covered call funds where you took the lion's share of the downside and had capped upside. And I think but then I think issuers innovated with spreads and different strategies. But anyway, then guys like you guys are coming out, which is basically, here's what I think. And I think the innovators that have been the most successful lately, the past 6 months, or the ones that I'm the most interested in, are the ones that have figured out how to uncap the upside. I looked at your structure. It has uncapped upside, not 100% exposure to it, but it's uncapped. So can you talk, what do you think about uncapped upside versus capped, Zed? What do you think about the option business, cover call business, the way it's going?
Yeah, I mean, I think going back to like the initial, what are you buying is incredibly important. Like, you need to understand what risk you actually hold in whatever instrument that you're buying, whether it's, mutual fund and ETF, if you're doing it yourself, you need to understand what risk you actually hold. And that's why we think it's very important to be risk managers instead of strike sellers. So what I mean that is, very simple. Last Friday, if you bought the S&P 500 and sold a 1 week cover call against it, your per dollar exposure to the S&P 500 was probably around 66 cents, 2/3 as you walked out the door on Friday. Yesterday, after a reasonably ugly day for most risk assets and markets, your exposure is probably closer to 100 cents. I mean, it moved dramatically on just 1 day move. And you're like, 2% move is decent, but it's not astronomical. That's not a big surprise. But your risk, went up 50% on a 1 day move. And so that's what we mean by like strike sellers are just, get on the treadmill, see what happens. Hopefully expires worthless, do it again. Where we think you got to understand exactly what you're holding and try to keep that exposure reasonably consistent, be a true risk manager. And with these products, ultimately, we're trying to deliver exposure of 100 cents of asset class A, 100 cents of asset class B. And as the market moves, we're doing things to get ourselves back to that home base exposure. So that's the first important lever, is we want to have a consistent risk profile. So when you're looking at the holdings, and you see some long calls, you see some short calls, as you mentioned right now, the short calls are, from a notional perspective or contract perspective, less than the long calls. So, technically uncapped. But what's more important is, as the market moves and my risk is getting off base, I'm doing something. I am getting ourselves back to that home base exposure of 100 cents on the dollar.
Yeah. So and that's what I figured. I figured you would. Well, okay. First of all, let's just talk about this. When I looked at the position today, and I'm trying to think, it was in IBIT, and you were long 300 leaps going out to next year, 345 leaps you're saying. But and then you were short, 120 calls. It doesn't matter. You were short a few less calls. Then you were short a couple of puts too, like 30 or 40, not very many. So, and I figured you would of course vary the amount of your longs and shorts, and how far you put them out of the money, and the tenor of them, depending on what you thought with the volatility surface and all kinds of stuff. I've watched some of your stuff before, like I say, and I know that you guys are big time volatility traders. And anyway, no, I'm really excited about this. I'm probably going to get some. I'm probably going to get some today. So which one would you get if you were me? If you could only get one, David, I'm going to throw you a softball question. Then I have more questions for you, Zed.
I love softball questions, so thank you. Bring them at me. I would say I am bullish on all of these asset classes. Like, I think gold, stocks, and Bitcoin all deserve to be in your portfolio. So because gold has been the one that has outperformed the most in the last 3 months, I'm going to say let's avoid the one with gold and buy the S&P and Bitcoin one. Just like mean reversion on asset classes, I think gold is a phenomenal long-term buy, but it's had an amazing 12-month outperformance on both S&P and Bitcoin. So I'm going to softball my answer right back to you and just say, honestly, the best free lunch is rebalance, and all of these assets deserve to be in your portfolio in some form or fashion. In some weighting, it doesn't matter, in my opinion, almost regardless of where you are in terms of your accumulation or distribution phase as a investor. You should have some allocation to all three of these. And so I first and foremost look at the ones that you have the least allocation to, but also the way we structure these, you can kind of have a 2-in-1. So it frees up your portfolio to do other creative things, whether it be take more beta or add to an alternative or sit in a short-term debt instrument, or, there's all sorts of assortments of interesting vehicles out there, STRC, right? This frees up you to do a whole lot of other things in your portfolio. But just given how well gold has performed the last year, I would say the S&P and Bitcoin one would be, just based on that, makes a whole lot of sense. But I think we're at such a weird bearish perspective on Bitcoin right now. Zed actually mentioned this to me the other day, like, go look at 10-year bonds in Japan, right? Like, a lot of people think that what's going on in the markets right now is due to like geopolitical risks and talks of Greenland, right? But a lot of it is just financing costs. Like, the 10-year yield on a Japanese paper, besides for today, has just kind of continued to go up for the last 6 months, from like the 1.6s to like the low 3s. And I'm totally stealing Zed's thunder here, but why is Bitcoin not performing well over the last 6 months? Well, go look at the yield of 10-year Japanese bonds over the last same 6 months. So like, I'm a big believer in Bitcoin. I think you guys all know that. When will Bitcoin really erupt is like when that cools down, that you can't have the ultimate financing cost of leverage of the world skyrocket and not expect assets that have some correlation to beta in general. Even though I do think the long-term driver of Bitcoin will be the money supply, you can't expect in the short run it to not have a little bit of sideways to negative movements.
Yeah, no, that's a good point. That's what I was going to do anyway. I already have gold. I already overloaded on gold. Yeah, that's probably the one I'm going to get. But I have some cash in the account right now. And anyway, I'm definitely interested in this. All right, so let's talk about this. One's for Zed, I guess. Let's talk about so I'm looking at the website. You say it's a new website. It's talking here about the portfolio construction of this structure, of this 3-leg structure that says long flex call, long deep in the money, synthetic. I call that a long deep in the money. It's 3 to 18 months is what your literature says. But then it says a short call option for premium, 1 to 6 months out in tenor. Then it says a short put, but it says 1 day to 30 days. Is that different on purpose? Why can the call go out 6 months and the put's shorter? And
then before you answer that, Zed, I will say the short call goes from 1 day to 180. So I don't think we'll always be using 1 day options there, but it does. It's a wide range there, as I alluded to. Like, 0 DTE options aren't the panacea, but occasionally they're a tool.
I got you. Yeah.
I guess I'll go backwards and forwards. So the puts in the strategy. So, again, the heart is we're trying to target 100 cents exposure approximately at all points in time. We're going to rebalance to recenter that as markets move. The puts are the most useful, we'll call it tactical instrument, but we're going to use them in tactical size. Like, as you see, it's, approximately 10% notional out of the gate in terms of a ratio from the long calls versus those puts. And that's what you should expect to see, somewhere in that zone, low single digits to when, if it gets crazy attractive, 20%. And why we started, we'll call it middle of that range yesterday, is we had a decent move in risk assets yesterday lower, and volatility across all those risk assets spiked reasonably attractively on the shorter end. And we said we want to get more exposure to selling volatility on that spike on the move lower in risk assets yesterday. Let's get more of our total risk exposure that we need to dial up to get to 100 cents a dollar per asset class from the puts, because that's allowing us to essentially sell a little bit more volatility and a little bit more downside skew, i.e., skew Flat means puts and calls are the same price. Steep means puts from a volatility perspective are more expensive than calls. And ultimately, on a move like yesterday, skew tends to go bid, i.e. people are racing to accumulate additional downside protection. So that's why yesterday it was by happenstance, the day it was seated, we had a decent position on the put side, but view that as the tactical lever as volatility is moving around to help us maintain our 100 cents exposure, but also lean on that lever if the opportunity is presented by the markets in terms of any sort of vol spikes or significant steepness and skew from people chasing downside. So we'll call it the least important part of the three legs, but one that we hope to use tactically to add a decent amount of value.
I got you. So how many times did you rebalance yesterday?
So yesterday was our seed day. So we, executed on close. Today we're more on the move. Obviously, it's a reasonably exciting day, but not as much as yesterday. But yeah, we probably would have had a handful of dances yesterday if we were live the whole day.
This one's for David. David, did you plan to come out after the vol popped? I mean, or either of you can answer this, but you guys, I know you file for these ETFs months in advance and you get approved, but do you ever try to release these right at the bottom? I know people started funds right around the April lows. You saw 2 or 3 funds that came out, right? Yeah. And I know those guys were doing that on purpose. Anyway.
Well, so what I'll say on that side is it takes 3 weeks. Like we have 6 more ETFs launched in partnership with Zed, right? So if we said tomorrow we're going to turn on 2 more, it actually takes 3 more weeks to turn it on. So like I think some of the managers can get a ballpark of when the right time is. But also I think some of what you see in history of like timing is like a little bit of luck. And if anything, like I think some of, that's if you take away from the income space of some of the, for example, single stock issuers that, Zed said this on other shows. He said it here today. One day it'll have a 1 beta. The next day it's 0.6, next day 0.2, next day 0.8, right? And then you guys look at a Yahoo chart in 3 months and you're like, look at the prowess of this manager, right? Like a lot of that is just like random walk and random luck, to be totally honest. And so we honestly wanted to get these out as soon as possible, but we're very thrilled to have these out like when there's a little bit more volatility to squeeze out some of these asset classes. But no, look, the SEC shut down for a long period of time. The new SEC chairman wants to defend names with income and yield in it. Like I think there's been a lot of tarnish done into the space because of some of the other products. So this candidly just took a lot longer than we had anticipated, but we are very excited to launch like after this a little bit of vol pop in a lot of these asset classes. And I'll finish answering the question you asked me earlier, and then I'll pass it back to you and Zed. You said, why is this category going to grow and how do yields not matter? I think there's 2 people buying these products. I think there's people approaching retirement that want to feel that they will get distributions, that have a real management team managing the underlying assets to try to make it something that they can depend on 5 and 10 years out, right? 2, there's the older generation like that that's like considering entering into the private markets, whether it be private equity or real estate. But irregardless of where rates are, the institutional world still just gets better financing. So like you're still kind of screwed competing with the institutions in that space. I put an asterisk saying like maybe institutions can't buy single family homes anymore. Maybe, like that's the one asterisk there. But then for the young generation, like everyone looks at the textbooks and say they need to put 100% of their assets in equities. First off, I think a lot of them are covering liabilities that they can't cover solely from their income alone. And partially, I think this is allowing people to, everyone says you should have 3 to 6 to 9 months of savings on the sideline, and then the rest you invest in the market. And I actually think this is making people feel more comfortable taking that number down and having less on the sidelines. So like the income space is actually allowing younger individuals to get more invested. The pie all of a sudden looks like, why are they 20% in income products? But if you think of it actually like pulling cash off the sidelines for them, I think that makes a whole lot more sense. So that the very long-winded answer again. But
I'll do the 10-second version. I mean, ultimately, we think we've collectively come up with a very attractive total return product that it's a long-term hold in portfolios. And it's just the total return is going to be a blend of, underlying asset price appreciation and distributions. But ultimately, at the end of the day, that's what we're focused on. Is you're going to hopefully buy, hold, and have a good long-term total return experience over full market cycle. And because we think we have come up with the right strategy, the right partnership, the right infrastructure, the right wrapper to achieve all this, we wanted this get launched months ago. But the real answer is we have to get through lots of hurdles, and by happenstance, we finally got there yesterday.
So let me ask you this on these. So when you rebalance, so you have Bitcoin, you have an IBIT option structure, 3 legs, a long leg and 2 short legs. But then you have the SPY, you have or not. So I don't know if it's SPX or SPY, but you have some type of market, probably the same structure. So it's your only goal. So that structure, which is a long call and then a short call and a short put, maybe you call it a covered strangle. I don't know. But anyway, whatever. Is that is your only goal to keep that at a delta 1? I mean, are you just, does that equal so that you have to keep the other one also and you have to keep them balanced with each other, so that's the real trick. You aren't making any market timing decisions, right? This is mechanical. This is just
it's reasonably mechanically, but you wander through exactly correct. So we want $1 invested to have $1 of exposure in asset class A, $1 exposure in asset class B. You can have A and B go different directions, which means we have to rebalance risk between A and B. We can have, because the options are convex, means your risk is changing. This morning, as an example, one of the asset classes was moving, and we were getting too low on exposure. We had to top it back up. We're going to be doing those things to both, A and B each be 100 cents of exposure, and then in between them both be balanced at basically 50% of the risk on each side. We're just trying to use our expertise in the volatility arena to not only do that risk management side, but be able to extract volatility risk premia, i.e., we believe that these major asset classes in general, volatility is too high relative to how much the market is actually moving. So we can actually harvest that volatility risk premia by rebalancing and keeping that risk targeted, and receive hopefully a little bit of compensation from the market by essentially having embedded short volatility in each of these instruments. And that's where the edge and the expertise comes into, outside of general risk management. But the risk management side is definitely, that's step 1.
Yeah, it's similar to BTGD. You should wake up every day and assume your exposure is pretty darn close to 100% Bitcoin and 100% gold. But then the magic and the value add is how you actually maneuver those exposures based on the volatility curve and the skew and all the other things that Zed started to talk about already. And as you alluded to, first and foremost, we're not capping and selling calls on 100% of the exposure. And then the puts that we do buy are an even smaller percentage of the exposure. So it's structured enough that you guys should expect to have 1+1 exposure, but still enough room for Zed to have the ability to strive for alpha in harvesting volatility premiums in these asset classes. So
and I never really looked at BTGD, but I just assumed you were using futures and just rebalancing futures all the time. Is that how you do that or not?
We're currently using futures for most of our exposure in BTGD. I will say you will see in the coming weeks we'll probably move our Bitcoin exposure also through the options world, but that's going to be a lot less actively, because we're not going to be harvesting volatility in that. That's just going to be pure exposure.
Yeah.
So that'll probably be done more purely through just a synthetic long position on IBIT. Just because there has been some slippage on the Bitcoin futures side, whereas the gold futures side has very little slippage. Bitcoin futures slippage is minimal. It's very, very, very small.
Sure.
But again, the beauty of this ETF world is you shouldn't just put products out there and just forget about them. You want to ever evolve them. When we launched BTGD, the volume in IBIT was very, very low, and it made most sense to focus primarily on the futures markets. And as the volume has picked up in the options market, it so bees that the roll cost is actually showing to be less in the options world than it is in the futures world. So still actively managed, the income stack here, albeit probably takes a little bit less, multiple rebalancing periods a day than these income stack vehicles will be. But same concept, like you always have 100% exposure. This will just be the exposure plus volatility harvesting premium as well.
So yeah, but no, and this is the fun part, because when you use options instead of futures, well, I guess you can harvest roll yield with futures, but whatever. But when you use options, you can harvest time decay, theta, whatever. So let's talk about that. So you have full 1-to-1 exposure both ways. Is that before or after the income comes out? Because the thing about any of these funds is the income comes out, is paid out of the NAV. And I mean, but anyway, so how do you decide? Let me ask you this. How do you decide how much to pay, how much premium to sell, and how do you ensure not to overpay so you don't have issues?
Yeah, so I think there's a couple layers in there. So expectations of total return performance, the underlying security plus all distributions, we really want that to look like this puzzle piece. We're going to say, it's 100% exposure to asset class A, meaning that's what you should expect in terms of one vertical of your return stream. 100% exposure to asset class B, that's what you should be adding to asset class A in terms of expected return stream. There's a cost of financing. You don't get leverage for free, so you got to subtract that out. And then we're hoping to generate, 2 to 4% additional returns from harvesting volatility risk premia. And then we think there's another 1 to 3% per annum of rebalancing premia, being able to go between asset class A and B as they oscillate in different directions. So that's kind of how we're adding everything up. A, B, minus financing, volatility, and rebalancing. That's what our expectation of total return looks like, and how it's going to be received is a blend of asset appreciation and distributions, just as we tilted a little bit more towards distributions in this product.
Yeah,
so
I'll just
go ahead.
Yeah, I'll just add on there. Like I think one of the managers we do have respect for out there is Neos. We think they're doing a great job, and like an internal benchmark that you could think of is like SPYI plus BTCI minus cost of financing. Like that's a very good barometer to think about. Sure. Like looking at us in terms of like what should our returns be on a day-to-day basis? An
index or a way to a benchmark for you, a little, or a way to kind of eyeball it. I hadn't thought about that. Yeah, no, NEOS, they do. Yeah, no, they do a great job. So let me ask you this. So I added up those numbers you were talking about, and I put the high end, and it was 1 to 4, and then 2 to 3 or something. So 4 plus that's 7%. So you're saying you can get 7% extra alpha maybe on the high end, or yield? Is that yield?
No, that would be what we consider more, alpha in the context, right? Because it's like pure beta would be 100% exposure to asset class A, 100% to be subtract financing. That's just a pure beta exposure. The rebalancing and harvesting volatility risk premium is, we'll call it in structural alpha, type of universe. We're not making, calls on markets, directions or things along those lines. We think it's structural alpha that we're embedded in the products. Yeah.
No, that's cool. So tell me what the yield's going to be.
So with that,
target, are you using a target, or tell me how you're going to figure the yield?
Well, if you go through that same, waterfall of where the return streams coming from, well, the most important two are the total returns of asset class A and asset class B, right?
Okay.
That's going to be the main driver. It's the main risk. That's going to be the main driver of return expectations. And because it's, 200% of, reasonably volatile assets between, S&P, gold, Bitcoin, our return range is going to be reasonably wide, like as one would expect. So, we're kind of targeting distributions of 12 to 30-ish%. Like that's the range of expectation. And again, if you just add all those legs together, that's where we're getting to that center point of the low, 20s. But we're acknowledging, if you're long 100 cents, gold and 100 cents Bitcoin, the return expectations for those two assets could be pretty wide over a year in both directions, obviously incredibly positive or not so much.
Yeah. And just saying, so you're saying 12 to 30%. But that's not all coming from option premium. Of course, you're hoping to capture some of that from just the upside of the two of them. Just I get it. The structural alpha, like you say. No, this is exciting. I think this should be fun. A little bit worried about the wonder if both of them drop at the same time. I mean,
so that's a great transition. So together. So like, again, you walk through, we're long, flex options that are leaps. That's our main driver of getting exposure to the underlying assets. We're selling covered calls against it on a portion of them. And then we got the tactical put side. But because we're garnering the core exposure to the underlying asset class from in the money leap calls and in the various three asset classes, that means there's built-in breaks in terms of the risk in dramatic moves. So yes, we're always going to be rebalancing back towards our home base of 100 cents exposure in each asset class. But if you had a hypothetically, first week of April where you have dramatic moves, we have that built-in breaks where our risk is actually going to decelerate on those really, large moves down. And so we think that with that, not only does it allow us to rebalance across asset classes more aggressively because we have the built-in, buffer in terms of risk reducing within the natural structure, but also allows us to rebalance into more risk more, proactively into those events than you otherwise would think with a leverage style ETF.
So let me ask you this. So like in an early April situation, you said that you have had to build breaks in or whatever. So how does that work? Can you explain it?
Yeah, because think about it. If you have 100 cents of asset class A, 100 cents of asset class B per dollar invested, theoretically over the next 10 years, that's going to be a great outcome. Our expectation is these asset classes to appreciate, but you got to be able to survive the intermittent downturns. That's where those, leverage gets you effectively into trouble, right? You're losing too much money. You have to de-lever at the worst possible time. So we acknowledge that as, something we need to solve within the structure to make it a long-term buy and hold total return style of vehicle. It needed to have some of those built-in breaks. So that way you're not in a forced deleveraging situation in the dramatic events that ultimately erode that path of compounding over the long haul. And that's why we're using those in the money leaps calls. Because essentially, if you're buying an in the money call, that means you basically own a put, right? Like that's putting in a little bit of that dampener during those large events. And so it's very intentional why we're using that as a tool.
Yeah, no, absolutely. Now you have a little bit of black swan because, like you, for instance, your strike is a 45, as I'm sure you know in IBIT, and so should something terrible, So I get it. You're liable down to 45. I mean, but no, I love it. I love the idea of it anyway. I love the idea of it. So let me ask you this. Could you not do kind of the same thing with the long allocation to volatility somewhere in there?
Again, we kind of have all right. So like the natural structure, because of the tenor mismatch of the options we have in there, is essentially a positive carry. They're collecting theta because even though we're selling less from a contract or notional perspective on those calls, the amount per day that those longer dated in the money calls decay is small, okay? And the amount that the shorter dated out of the money calls, even though there's less from a contract notional perspective, decays much more quickly. So that package does have a positive decay, i.e. we're collecting theta every single day. But we're long Vega, we're long volatility because there's very little actual volatility, i.e. the Greek Vega in those shorter dated options, both on the put and call side. But there's a chunky amount in a 1 year option. So we have that, if things go dramatically awry, yes, you have the natural, dampener of going from an in the money call to an out of money call. Okay, your exposure is declining during the dramatic move, but you also might get a little bit of a kicker that you're actually long volatility or long Vega, and that expands at the same time, helping again that little dampener for a product that has leverage, even though during those potential dramatic drawdown events.
Absolutely. So let me ask you guys this: have you guys filed for any more of these stacked income stack products? And I should know, but I'm sorry, I don't.
I love the layup questions. I'll take that one. So we have 8 filings with as a Convexitas. So 6 are income stacks. So far we've come out with ISSB and ISBG. That's income stacked Bitcoin and gold, and income stacked stocks and Bitcoin. But over the 6 we launched or we filed for, we have stocks and Bitcoin, stocks and gold, treasuries Bitcoin, treasuries gold, stocks and treasuries, and then Bitcoin and gold. So all the combinations you guys would want of stocks, treasuries, Bitcoin, and gold for positions that, like, in some fashion you should have maybe some exposure to, some diversification benefits between the 4. So those are our first 6 filings. And then our last 2 are probably even one step further into the hedge fund foray. They're what we're calling our MNAV Harvester series. So one is cheekily tickered YTSM, which is MSTY in reverse, and the other one is ticker is MNAV. And the concept there is, there's a lot of volatility in crypto treasury companies, and there's volatility to be harvested. But if you saw the actual experience of being a shareholder of something like MSTY over the last year and a half, like, you might want to harvest the volatility on that asset. You might not actually want to do it and be directionally long that asset. So for example, like if MicroStrategy was at like a 2 MNAV, we could be, having that short call come on MicroStrategy and then the long call coming on Bitcoin. And then we would still be harvesting the volatility in MicroStrategy, but we would be able to pair it with a long in Bitcoin. So you can think of, like, for example, YTSM, a strategy that will be long Bitcoin and then can go long or short different crypto treasury companies. And if there's no opportunity on either side of that, also just harvest volatility on Bitcoin. So it's kind of like a mix of, BTCI, MSTY, and Winter. If you kind of put them all into a baby and said, and again, that's along the lines of, we're trying to create true full portfolio solutions and not just trading tools where the onus is on you to do the trade. We're like, well, this is the trade. Do you like the long? Do you like the side? Do you like the underlying reference asset Bitcoin? Like, you decide. We think it's really hard for individual investors to make those difficult decisions. And I'm not saying we're going to hit, 100% accuracy on all of them, but, like, you don't have to hit 100% accuracy on your directional trades to do very well in a hedge fund, similarly in an ETF. And so those are vehicles that are meant to choose those positionings based on the opportunity set, the volatility between the DATs and the underlying reference asset like Bitcoin, and also what the MNAV is on each individual crypto treasury company. So those we have not launched yet, obviously, but that completes like the suite of 8 that we filed with Convexitas, and we have some new stuff cooking as well that we should have in the filings very soon. We're revamping an old filing that I think you guys are going to find very interesting as well.
Really? Okay. Yeah, I'll keep my eye on Edgar for that. No, those crypto treasury plays I think are interesting. I think that some hedge fund has that trade on or had it on. It would short MicroStrategy and long Bitcoin, or vice versa or something. Anyway, but I think
you had it right. You had it right, and we incepted that idea in June, and we foresaw us coming out very aligned with that trade. But he has since unwound that trade. So, like, in some of these crypto treasury companies, there's now value on the other side where they might be trading at like a 0.6 MNAV, and there's actually reasons to go long. And in that reference, like, I'm not saying one way or the other on any individual one crypto treasury company here. You'll have to wait and see when that comes out. But there's exciting opportunities in that space as well. These make a little more sense as a first introduction into the category, just because these are broad asset classes that you already need exposure to. So, doing it, understanding the ability to harvest a little bit of volatility premium, and using the concept of stacking, return stacking, portable alpha. Portable alpha has been around for a long time. PIMCO started it with their mutual fund. Fun fact: PIMCO just filed for stacked stocks and treasuries without the derivative income. So they're just normal exposure. They basically, we have the derivative income version of what they've just filed for. So we're happy to compete on a one-to-one basis with them on that. I think this category of return stacking is just growing, and it makes sense in the derivative income space because it appears to be that you guys are more allocators than traders in these products, and you do like the leverage that allows you to outperform not just on a risk-adjusted basis, but also a total return basis. And this is a way to do that where you don't need to manage the leverage. We embed the leverage. We do the difficult rebalancing trades, the unemotional rebalancing trades. We get the institutional cost of financing, and it's a better long-term leverage experience as a shareholder than you can get really in any other leverage vehicles. So,
yeah. No, absolutely. Hey, does anyone in the audience have any questions? Put them in the comments. We're getting close to the end of our time. I need a new set of glasses now. We have a few more minutes. No, I'm really excited about these. I'm looking at some of the comments. Somebody said 12 to 30%. That's kind of a wide range, but anyway, it is what it is. I just want you guys to make one that's 30% and has no, and the NAV never goes down. The NAV can only go up. It's all right if the NAV doesn't go anywhere. The NAV can either go nowhere or up, and it has to pay 30%. Could you guys do that at all times?
I can say these will be products that like the NAV can rise with the underlying asset class. And I think that's been, as you see the calls we just wrote on, like it's we're not writing on 100% of the calls. Like the strike will vary in different times, whether at the money or out of the money. We will give you guys that exposure. And so I think, this whole, like, is this a no NAV erosion fund or not? It honestly really comes down to like, how much upside exposure are you given in the fund versus how much downside exposure? So we'll have our first dividend come out soon, and you guys will see some more information on that side. What I will say is we won't overpay just because of a drawdown. And I think that's really important for being a long-term shareholder in these products, right? So some of our competitors will say, oh, we're down 10%, but guess what? Volatility was so high, we're going to pay even more of that out of the fund. And that just continues to erode the NAV further. So it's two things. One, don't overpay when there's a huge downside. Like you'll see us like tend to like keep our payments like pretty flat from what it was before the drawdown. And two, bank some of that added premium in those drawdowns to pay on the upswing. And again, that leads to a better investor experience on like, if anything, we want to minimize like you can't do it week to week, but like the year to year distributions. We don't want you to be a 5-year shareholder in this, in year 5, get like 1/20th of the distributions that you're getting in year 1. Like we want you to continue to be able to get similar or increased distributions 5 years out as you're getting now. And the way to do that is to not overpay. Zed has said this in other vehicle interviews we've done, like, there's no free lunch. It's just the total return that you generate from the underlying asset and the volatility harvesting. And, you can choose to receive that as distributions or in actual growth of the NAV. Now there's some rules on, we can't hold back premiums. We do have to pay 90% of our premiums out for the RIC rule, et cetera. But the goal is that, like, in 5 years, you're going to have, on a year-by-year basis, probably similar or increased distributions then as you will now, which I think is actually what people wanted when they entered this category. But they just got a little bit like, wait, I can do that and have 80% yields. And I think they've now realized, no, that is not possible with 80% yields. But if we're targeting that, like, 20, 22% baseline yield on average between 12 and 30, and if the fund is going up a lot, we'll increase the payments a little bit from there and pay out some more of our premiums. Like, again, we are looking 5 to 10 years out and saying, like, what is the good shareholder experience of someone in these products for 5 to 10 years? Not just like, how many assets can we raise in 30 days? Because we have this like crazy number of like, there have been some 0DT options, like their first print was like 330% distribution rates. Like, I think by that time, everyone saw that and was like, okay, that's not real. But like, you can kind of engineer these things to look as high as you want. It doesn't mean that they're quality or sustainable over time. Yeah,
I have some of that fun, by the way. Anyway, that's neither here nor there. But no, you're right. That was a great, but I didn't buy it on that day. I bought it a few months later. Anyway, whatever. And so what I keep hinting at, guys, I know we have a few minutes left, and there's not really any questions really coming from the audience. They're just making nice comments telling you guys things.
There's actually, I see one, if I could just
maybe here.
So someone asked when the first dividend payment is, and so because we are going to have a little bit of a short week on our first one, we're going to be a Tuesday payer, X on a Friday. So our first payment will be February 3rd, declared on the 30th, and not this Friday for next Tuesday, because we do want to, again, the goal is to continue to have premium to pay you guys and not just erode it. Like, we don't want to start making payments and eroding the NAV really early. We need a couple days to actually generate the premium, right? But we will be a weekly payer from there on out. So both of these funds will pay on Tuesdays. And you'll see press releases from us when those numbers get announced on Fridays. But not this Friday, next Friday.
On next Friday.
Yeah.
That's awesome. That's awesome. No, I'm really looking forward to following these. I've already built the positions in an option simulator program I have, and I'm gonna do some content on it tonight. So anyway, but no, I really love the ideas of these, and I can't wait to see how you guys manage them. Let me ask you this, Ed, are you going to publish the intraday trades like some of these people do, or am I just going to be able to see the end of day positions?
Yeah, well, but more of a David question, but ultimately the goal is yes. We'll see if we can get it all accomplished.
Yeah. I think Zed is right. We will. It's going to take us a couple of days, but we fully intend to have an intraday file and then an end of day file, so you can back out like the two different rebalancing periods. But give us a couple of days, maybe a week. And then we'll get that running. So
it's not just me, and you guys know this, but other influencers will take those trades and evaluate them and ask for interview. I mean, it's just good to get that information out there, because people are, especially on this more sophisticated strategy like this, I think is going to have a lot of interest in how the heck Zed's doing this and stuff. I know that I'm looking forward to it myself. All right, guys. Well, we've about run out of time. I'm going to let these YouTube people go, and I'm going to stick around here and talk to these guys for a second. But anyway, hey, guys on YouTube, thank you so much for being here. Thanks for watching the show. Go get you some of this fund. I'm going to go get me some of this fund before the end of the day. All right.
Thank you.
Yeah. All right. Let me end this stream.